that was not a pretty jobs number, was it?
It was a weak jobs report, no matter which way you look at it, whether you look at the headline or whether you look at the details. So we were expecting a slightly weaker number, and we got it. But what's interesting to me in the details of the report, if you look at the category of unemployed for less than 5 weeks, we've actually seen the number there pick up a little bit to 2.1 million. And the other interesting thing to me is that we're seeing some cyclical weakness starting to develop in these unemployment numbers. For example, we saw hiring in professional and business services, but we saw very little hiring in mining, manufacturing, trade, wholesale and retail, and also leisure and hospitality. You would expect these sectors to actually be doing well going into the summer season, and that's not the case. No net new hiring there.
What's your thought, Rick?
It's a weaker number. I mean, if you put it in context, overreacting to one number can be a dangerous thing to do.
It can be, yeah.
So if you take it as a 3-month moving average is 150,000 jobs, and you say, okay, that's not that bad. That's about where we should be running. However, I think Anastasia said it right. You're going through for the next couple of months. You've got uncertainty on trade, and if you're a corporate CFO, treasurer, you're going to start to pull back on what is my funding, how do I think about inventory and capex. And by the way, the weather hasn't been so good either. So we got to see, the data for the next month or two, particularly manufacturing and inventory builds, et cetera. It's going to be soft. So the Fed, whether they make a decision they need an insurance policy or not based on this is going to be interesting.
Mike Collins?
Yeah, I concur with Rick that you're not supposed to panic or overreact to one number, right? The averages of these monthly job gains, they're running 250, then they went to 150, then we had the stimulus 2 years ago, they went back up to 200, and that was what we've been talking about for the last couple of years. That was the really surprise, how they kept being elevated in the later cycles, and now they're just going back to what we would expect them to be. This is like a run rate, normal kind of pace of job growth, and the narrative that Rick just laid out that, business indicators, manufacturing indicators, business confidence are all waning.
Yeah.
So this is very consistent with the narrative we've been talking about of slowing global growth.
Anastasia?
That's right. That business confidence is so important. And by the way, this jobs number the survey was done before you actually had some of the worst of the escalation of China trade tariffs and Mexico trade tariffs and so forth. So this is a very important trend to watch, not to overreact to one number. But if you couple that with PMIs that are really on the cusp of 50 right now, this is an economy that is really at a crossroads right now.
You guys say don't overreact. I mean, futures are positive, up 0.25% on the S&P 500. The overreaction, maybe, and I'll ask you the question as to whether it is an overreaction, the front end of the yield curve's coming in 9 basis points. Again, Mike, the price action's there. So let me ask you, do you think that's an overreaction? Yeah,
the markets are pricing in basically about 100 basis points of cuts over the next year or two, right? That feels like a lot. So maybe what's happening is the markets are pricing in a high probability of just a cut or two, but then a maybe 1/3 probability of lots of cuts, right? Like the Fed going to zero. There's a lot of literature, and the Fed just came out with their meeting in Chicago where they're trying to reinvent monetary policy, and what they're talking about is being more aggressive in the next downturn, getting to zero more quickly, and issuing forward guidance and doing more QE. So maybe that's being priced in.
Rick?
Yeah, I think it's all right. And not only that, you have a couple of things that are important. The front of the yield curve carries really well, and on a global context is quite attractive. So you almost have to price in a cut or two just because it's so well funded for in terms of carry. Second thing is we talk about the number of cuts. Cuts can be 50 basis points when you start cutting rates. It's different than when you start raising rates, and you do it very deliberately and you very much orchestrate, here's how we're going to do it. When you cut, you tend to be surprising, you tend to do it faster, and you tend to do it more aggressively. So the markets are pricing in now is they could start to get 50s in and start to move rates down.